Hey guys, welcome. Let me know how your day is going in the chat.
You know about to do what? Walk in that door.
Yeah, there. That's what cooked when you order
Sorry,
juicy beef
guys.
sounds like. The steaming hug of 2 slices of melted cheese.
Give me 1 second.
All right. Can you see my screen share?
I can't. Yeah, I could now.
Cool.
Hey guys, how are you guys doing? Yes, I can see your screen. Welcome everybody to our Wednesday night multifamily Freedom Chasers debt financing Zoom call. How is everyone doing? My name is Shelly Miles. I am a commercial mortgage broker and the co-founder of our brokerage company, Adventure Commercial Capital, together with Mr. Jerry Miles over there, which you will hear from him soon. If you want to go ahead and turn your cameras on, good to see everybody. That would help me out a lot so I don't feel like I'm talking to a blank screen. So what our company does is connect real estate investors like yourself with lenders. Investors that want to buy multifamily fix and flip, storage units, hotels, any business that has real estate attached to it, because our investor is unique. I'm sorry, but each investors are unique and each deal is unique. So we have the skill to understand what you guys need to connect you to the right lender. With that, I'm gonna start here and talk about our agenda today. So today's agenda, we're going to talk about our community ecosystem. I'm going to introduce you guys. Actually, those of you guys who are new, can you guys let us know by putting a 1 in the chat and also where you heard about us? So we're going to talk about our community ecosystem. I'm going to do, Jerry's going to do an introduction for us, and then we're going to give you guys an opportunity to introduce yourself so you get known. And then he's going to give you a current debt market update. We're going to head into our main topic, which is what are sellers waiting for? And then we are going to end with Q&A. You want to go ahead and go to the next slide, dear?
Yep.
While you're doing that, I'm going to grab this link.
And so these are all the different places that you can
You missed a
connect with the
slide.
Freedom Chasers.
You missed a slide.
I did. Oh, shoot, I did. Sorry.
I'll do that. So here is our community ecosystem. It's a community like no other. We have, let me bring up mine here. Is anybody seeing my screen or you're just seeing Jerry's screen? It's just your screen's up, right? Okay.
Just mine.
Okay, so we have 4 major Zoom calls that we do on Mondays and Wednesdays, alternating. On Monday, we start off with the activation Zoom with Marcel, Trevor, and Victor. These are the 3 guys that started off the Multifamily Freedom Chasers. And you can get activated with them for the week with a celebrity guest. They usually have a celebrity guest on here to speak every other Monday, and you get unrivaled educational value, and it's a community building at its finest. They alternate with BB and Iffy on Mondays. They do asset management. After you close a deal, now what, right? So they help you with that. They teach you the fundamentals and explore real life scenarios, challenges, and solutions for multifamily freedom operations. Then you have us. On Wednesday, we do the debt financing Zoom call. You get live updates on the current debt market, and you learn what it takes to find and qualify for debt to take down a big multifamily deal. And then we alternate on Wednesday with deal sourcing and underwriting with Ed and Kevin. You're going to learn how to engage with brokers, source deals, and underwrite them quickly and efficiently with Ed and Kevin. These Zoom calls, guys, are free and it's at top level. So if you haven't joined any of them yet, and if this is your first one, go ahead and start joining them. I'm gonna put the link in the chat. If I can't even see my chat. If I can see it, I will see. Give me 1 second. It's hidden. There it is. I found it. Okay. Yes, we have some new people. Welcome everybody here. I'm going to share this link. This is the Facebook link. Click that if you're new. You'll get access to all of these Zoom calls. It's only 2 nights a week, Mondays and Wednesdays, and it's alternating. That's 4 Zoom calls. And there you go.
And it's free.
And it's free. Yes.
Yeah.
And thank you guys for turning
yeah.
your camera. I see your pretty faces.
Yeah.
Go to the next slide, please. So you can plug into the community through Facebook, YouTube. Just go to Multifamily Freedom Chasers. You can get us on Spotify, on Instagram. I'll share our Instagram stuff here in a few. And then we will be sharing the WhatsApp group. We have a link for it towards the end. You can just scan it. I don't have a link on me right now, but at the end we have a QR code you can scan. There you go. Take it away.
All right. All right. So I'm Jerry Miles. I'll go ahead and introduce who we are, and then we'll give a couple of you an opportunity to tell us about yourselves, what kind of business, maybe a little bit about your real estate journey, where you're at. So that is me and my wife, Jerry and Shelly, and then 2 of our sons, JJ and Jordan. JJ has just graduated high school, and Jordan is going into high school. So we are commercial mortgage brokers and co-founders of Adventure Commercial Capital. We started out about 20 years ago running a construction company. We still have that company today. And it's, it feeds us and keeps us going every day. About 10 years ago, we started investing in real estate. Through that process, we ran into some shady brokers and things that would try to hook us up with money and things and terms that we just weren't comfortable with, and fees we didn't like, and they just weren't honest with us at the same time. So about probably 5 years ago now, we this signs me out every week about this time. We decided that we were going to take our lending into our own hands. We saw the need for people in this business to broker the money and to help real estate investors grow, that we're going to be honest with people, not overcharge, but to be a service to the community. And so that's what we set out to do 5 years ago. And we're 5 years in. We've survived COVID. Now we're surviving the rate hikes, and so it's not a friendly business to brokers right now because of the low volume. But we're still our heads above water, and we're working on growing and taking marketplace space from the people that are closing up shop. So there's plenty of those right now. We'll talk about that as we go here. So any of you all that want to share, I will tell you, if you haven't yet, put your contact info in the chat. Let us know who you are, what kind of things you're looking for. We have known people on this chat and on our calls here that have done business together. They've met each other on our calls and they've done business together. So I know several people on the call now that have bought big deals have closed big deals. There's a few familiar faces here that we've done business with that, hey, and here's one coming on now. But yeah, so there's high level people on here, there's beginners on here, there's a good mix of people. So let people know who you are and things like that. So if you would like to introduce yourself, raise your hand, digital hand, and we'll give you a chance. Well, go ahead.
Okay. Yeah, I saw Jeffrey said he got an email from us. That's how he knows about us. And then Larry, welcome. This is your first time. He came across the MFC page on the MFC on Facebook. Rochelle, I'm on the email list. Can't remember how I found you guys. We got Elida. I'm sorry if I pronounced your name wrong. I apologize in advance. She was referred to by Phil and located in Tampa, Florida. Jeffrey, you said you missed the asset management class on Monday on the MFC Facebook page, which is the link I shared a few minutes ago. If you go on that page, you will find the asset management recording and you will get access to that. Also, you can go on the YouTube page and you'll have access to that as well. Hello, everyone.
All right, awesome. So I see JJ's got his hand raised.
Hey, here's Aldo. He just joined. Hi, Aldo.
Aldo, nice. It's been a while, Aldo. JJ, go ahead. We got 4 of you, and that's probably all we got time for. So go ahead, JJ. This is JJ. He's our son. He helps us out with the tech and things in here. So
yeah, my name is JJ Miles. I am their son, like they said, and I just come in here to help moderate and do stuff like that. And I'm a YouTuber. That's my job. So yeah, a little bit about me.
Yep. So, and it's not just a dream anymore for him. He now gets paid for YouTube and actually just took a job with one of the top 3 creators on the platform that edit videos for him. So he just got that job and going to be starting work with one of the top creators our 3rd top creator in YouTube. So Rochelle, how are you?
Good. How are you? I love that your son's on here. My son's on here too.
Awesome.
Yeah. So my son and I, we do multifamily, and I just love your videos. I've been on some other ones, but it's been a few weeks. And so you're saying all your recordings are on YouTube? I can go watch the ones I missed?
Yep.
Yeah.
That's awesome.
A year and a half's worth of recordings on there. So
Nice.
Yep.
Jeffrey, how are you, sir?
I'm doing great. I'm doing great. That's good to know because I was just definitely asking about the recording on Monday because I missed it. The asset management. That's one thing I wanted to do. Yeah. So me and my wife, she's right here. She's kind of over to my right. But anyway, we do fix and flip. We just now stopped doing fix and flip. We want to get into multifamily. So we actually just sent out an LOI for a hotel, to purchase a hotel, and we want to convert it into apartment complexes.
Awesome.
So we noticed that there's a lot of money out there for that. So we want to get our feet wet in that area there because we want to build the residual income.
Nice.
That's awesome. Glad to have you guys. Glad to have you, Rochelle. And what's your wife's name? Jeffrey?
Annette.
Annette.
Oh,
nice.
My name is Jeffrey. Her name is Annette.
Annette.
Awesome.
Yes, Annette.
Nice to meet you guys.
Nice to meet you too, Sherry and Jerry.
Yeah. And Selenice, it's good to see you.
Can you hear me?
Yep, we can hear you.
Okay, great evening, everyone. Good to see you again, Jerry.
Yeah.
And Shelly, thank you so much for the book.
Hey, okay, you're the one that received it. Awesome. Glad you got it. Hope you like it.
Yes, I'm still reading it. So yeah, this is actually my 2nd time on the call. It was great to meet your husband, and I'm here. I'm retired Miami-Dade corrections officer of 30 years. I'm doing real estate at this time. I became a real estate professional like maybe 5 years into prior to me retiring, because I knew I was going to be retiring early and I would have need something to do. So I'm a realtor. I'm a realtor, and I'm also an investor, you know, with Grant Cardone in the joined the real estate club so I can learn more about the multifamily investment in the bigger units. I used to own a triplex and duplex, but now I'm moving on to bigger and better things. So I'm here to learn, to grasp everything that I could to step into those waters of multifamily investment.
Awesome. Glad to have you here. And it was good to meet you last week.
Glad to have you. Sorry I didn't get to see you.
Yes.
And
We
before
will.
yeah, go ahead.
Yeah.
Awesome.
It's true.
All right. And so before I have Larry, I will say that my wife has failed to put that in her introduction, and I haven't put it in. Amazon best-selling author now. So she was part of that book that Celanese held up there, best-selling author, Amazon's best-selling author. So we need to write that in on all of her stuff now. So
I
I
do.
brag a little bit.
I forgot.
So she's humble. She doesn't want to talk about it, but I'll talk about it. So, so Larry, good to see you, man.
How's it going? My name is Larry Jones. I'm located out of New Jersey. I'm new to the real estate world. My focus is multifamily. I'm looking to target the markets of Ohio, North Carolina. Looking to network, build relationships, and get some deals done and help people be an asset to my community.
Awesome. Oh, glad to have you here. And we're in the Cincinnati area, so we're not too far off from from Ohio. We're in the Kentucky side of Ohio, but there's several people on the call here that buy in Ohio, so you're in a good place.
Glad to have you, Larry.
All right, well, I'm gonna get started with the current debt market. The rates currently, the Fed rate, has been unchanged now for quite a few, 5.25, 5.5. It's the highest federal funds rate in 22 years. The treasuries here over the last 4 or 5 weeks have been coming down. We look at the treasury rates, the 10-year, 5-year, 7, 3. When you're looking at getting a 10-year term on a loan, or a 10-year term loan, you're going to look at that 10-year treasury rate, and that's what your rates are going to be based off of. So the bank will put a spread on there. So when you have a 4.29 treasury, the bank has a 2-point spread. You're going to be at like 6.17 on your final rate, or 6.229 on your final rate, depending on what term you're going after. So that's on personal, on your regular home mortgages, as well as a lot of the long-term mortgages on commercial real estate as well. So could they go higher? We've been almost up to 5 here over the last 6 months or so, and we've been down to almost 3. So I mean, when you're talking 1 point, we're going to go into some of the rates and how the rate changes the valuations of properties and just all these things today. And so we'll talk more about that, but who knows? They could go higher, they could go lower. We were at Grant Cardone's real estate summit in Miami last week, and he was saying that he thinks over the next 2 to 3, maybe 4 years, we could see 0% rates again. Who knows? I'm seeing other guys. If you watch some of the gurus on the national, financial news, and then some on YouTube and different ones, there's some that's saying that we could see double-digit rates. So it just depends on what you're looking at, what you think. To me, I'm not foolish enough to make predictions because I don't control it. But it's going to be fun to watch where things go from here. I said the these right here, this is Freddie Mac small balance loans for multifamily. So Freddie Mac and Fannie Mae, they have what they call small balance.
You froze. Can you hear me? Hang on 1 second.
Jerry froze, yeah.
Yeah, he did freeze. Can you hear me now?
Yeah, we can hear you. We just can't hear Jerry. He's froze.
Okay. Bye.
All right. Can everybody see me now? My whole computer shut down. So give me just a minute and I'm getting ready to get it. Oh, it locked me out of everything. So if you all bear with me just a minute, and I think you're muted, Shelly, if you're talking to us.
You want me to share my screen?
Go ahead and do that if you don't. Oh no, I've got it here. Got it now. Share screen.
These are the things we are never prepared for.
And here we go. All right. So, yeah, the whole thing just shut down and I was out of Zoom. I don't know. That's never happened before in the year and a half of doing these Zoom calls. But anyway, this right here is the most updated list we have for the Freddie Mac small balance loans. The small balance side of Freddie Mac and Fannie Mae. On Freddie Mac, it is 2 million to 7.5 million. Is the small balance loans. They'll go to 1 million, but you're going to get your best rates and terms 2 million to 7.5. When you hit that 7.5, you go into what's called the conventional rates. Those are going to be a little bit lower. The spreads are smaller. So where you see like in this middle line, 5-year hybrid, 65%, where you're looking at 5.79 to 6.19, you're probably you could take a quarter point off of that when you get up to those conventional rates. So this is kind of what you're looking at. You know, you see the loan to value, the DSCR numbers, and how it affects the rates. Other things that affect the rates are location of property, the buyer's experience, or the sponsor on the buyer side, the sponsor's experience. Crime rates will affect the rates. Higher crime rate areas always have higher default rates on loans. It gets hard to, if it's hard to collect rent or you have to carry a gun to collect rent, you know, it's tough to manage that property sometimes. You know, so those will, you know, put you up higher on the rate side. Things that will help the rates, bigger populations, big cities help your rates go down. More employment opportunities help the rates go down. And one of the big things that help the rates go down, Freddie and Fannie are mission driven. So their mission is to provide affordable housing to the population. And so if your average rents are below market rents, you're going to qualify for better rates as well, you know, because they're mission driven. So that's a Freddie Mac small balance. Here's the Fannie Mae small balance. Like I said, you hit the conventional side on Fannie Mae when you hit the 6 million mark. Fannie Mae likes the bigger populations. You know, if you're going after something that maybe mixed use, you're going to probably go Fannie Mae. Freddie Mac, you know, if you're looking at some, you know, there's a lot of small towns in the South that are growing, you know, that, you know, maybe don't have a higher population yet, but maybe have some big employers moving in and stuff. Those, you'd go with Freddie Mac on those types of deals. There's a lot of different nuances that go as well, but just kind of general rules. You know, we've had a stagnant market over the last, you know, year and a half to 2 years, just because when the rates went up, you know, if sellers didn't have to sell, you know, they couldn't pull profit out anymore. I mean, people were selling to pull profit out, you know, the years previous. And when you can't pull profit out, and then you might, when you sell, you might even lose money. There's no incentive to sell. So we'll talk a little bit today about what's going to incentivize people to sell and why they're going to be forced to sell, things like that. But it's been pretty stagnant because of that. They're saying half of all mortgage brokers will leave the business this year. They're saying half of all realtors or more are going to leave this year just because there's not much activity going on, and they can't make it's not paying their bills anymore. You know, there is a lot of deals that are going to be coming to the market. Some more opportunity coming. There's a major correction underway. $2.7 trillion of debt maturing by 2027. You know, 540 billion in 2024, 540 in 2025. But these numbers, I believe, will actually be higher. Just from the people we talked to, that, you know, their debt was due in 22, their debt was due in 23, and now they've just they've kicked the can down the field a little bit and hoping interest rates are going to drop before they either sell or refinance. They've just gotten extensions on their loans or paid you know, cap rate, you know, rate cap insurance, different things like that to keep their rates a little lower and to kind of prolong their ownership of these properties. So but we'll go ahead and get into the main topic. You know, the topic is, what are sellers waiting for? And you know, so before we, you know, really get into, you know, answer that question, we need to kind of understand where sellers are coming from. You know, so what are the reasons that people are selling, or why is a property listed? Yeah, I said before, people would sell because, you know, they had a business plan of, I'm going to hold this 5 years. We're going to, you know, build the value. We're going to end up selling in 5 years and we're going to make a ton of money. You know, that's really not happening right now. You know, because of the interest rate environment. And now, right now, we've got stagnant rents. You know, stagnant rents means, you know, rents aren't going up anymore. So you're not gaining value because of more income of the properties. So, you know, reasons in this market why you would see a property listed or why somebody might be selling. You know, number one, you know, they might just be feeling out the market. You know, they might just be putting it on there, say, hey, you know, I'm going to put my price, what I want for it. If I get it, I get it. If not, you know, I don't have to sell it. And they might just be doing this just to feel out the market. When we were at the real estate summit last week, Grant was there on stage and he was talking about this, and he was saying, I think more than 60% of the properties listed online right now are people that are just feeling out the market. And so then he asked Ryan, you know, his partner there, and he said, I think it's probably 50%. Yeah. And then, so then they started calling brokers, and brokers are saying, you talk to one broker, and I think he said, I think 10 or 20%, you know, are feeling out the market. You know, these guys are salesmen, so they've got to really push into these properties, you know. And then they called another broker, and that broker said, I don't know, maybe 20% of the people that have properties listed are just feeling out the market. So, you know, another reason why people might be selling is their debt is due. So we're going to come back to that one. But what does that mean, that debt is due? You know, if you take out a loan on a multifamily property, it's going to be amortized for 30 years generally. But you're going to have a term on that loan. So that loan is going to have a 3, 5, 7, 10 year, maybe a 15. If it's a HUD loan or something, you could have a 30 or 40-year term on the loan. But you know, when you sign those papers for that let's say it's a 5-year term. At the end of that 5 years, the rate becomes adjustable. And so at that time, these people, currently have been paying, 3-4%, and then now it's going to change and it's going to be 6 or 7%. So it's a big deal, and we'll talk about that some more. I've seen some properties that are listed for sale, and dealt with some of these deals where, they might be having management troubles. They've got, people fighting, managers or owners, the part of the ownership team, they might not be getting along and things. So that could be opportunities to buy. If you got two people that hate each other so much that they're willing to take a loss, or get rid of the property without get rid of the property for less than they want, just because they can't stand that other person so much, or there's a lot of reasons that could be going on there. I mean, somebody dying, a lot of properties, if the person that's in charge of the property dies, I mean, they might have it in their will to force a sale, or they might have a wife or kids that get tired of this person, always talking about their properties and putting all this time into them, and they, this person dies, and the kids and the wife or whoever decide, man, I hated this property the whole time. He spent every weekend at this property cutting grass and, whatever it was, so a lot of different reasons, when you're talking about management troubles, and then maybe I said, that taking profits really isn't a thing, but if you have somebody that's owned the property for 10 or 15 years, they could still take a profit today. I doubt somebody that's owned one for 3 to 5 years is going to be able to sell it and take a profit today in today's market. But if you have somebody that has owned a property for 10, 15, 20 years, they're going to pull out a big chunk of money when they sell, unless they've, leveraged it to the max every chance they got. So, so going back to that, problem of debt is due. Why is this, such a problem? A lot of the debt that's coming due, I mean, these things are, 3 to, 4.5% interest rates, a lot of them. Okay, so we're going to go through a few examples. For some of you, this might be real elementary and you might know this stuff. Others are going to, maybe not. So follow along with me here. If you have any questions, we'll be doing Q&A here at the end. But when we're looking, properties are valued by the NOI, the net operating income. So when we're looking at a property, the property on the top, this could have been a property that was purchased, 2018, 2019, something like that. But they have $500,000 in net operating income. So net operating income is, all of your income minus your regular expenses, not counting your mortgage expenses. So $500,000 back 2019, 2020, if you bought this property back then, you're going to have a 3.5% interest rate, which means you probably bought the property at a 4.5 cap. So this $500,000 NOI at a 4.5 cap gets you an $11 million valuation. Giving you a 3.5% interest rate. The property on the bottom, same property, $500,000 NOI. When we're looking at current rates at 6.5, you would probably be able to sell this property or buy this property at 7 cap. Which puts a 7 cap puts a value of this property at 7.1 million. So the difference in that is, I mean, you're looking at 3% different in interest rate, and you're looking at, I mean, this is, about 60% of value of that one. So I'm going to pull this up just to kind of show you. If you look at this, this is something that my wife put together, Shelly there. She made this here, I think, on Excel, right? You just put it together. Is that right?
On numbers.
On numbers, okay. So if we're looking at this property, and we're going to go ahead, I'm going to go ahead and go to the 3.5% interest rate.
Are you trying to share something on your screen? Because we're not seeing it.
You're not seeing it? Oh, shoot. Okay. Share. And here we go. Can you see it now?
Yes.
So this property here, we said it's valued at 11,101,000 $11,111 is what you come to when you do a 4.5 cap on it. Sorry, 35. So on this situation, you buy this property for $11 million. You've got a 3.5% interest rate. Let's say you bought this in 2019 on a 5-year term. You put 35% down, which, after all your closing costs, inspections, all that, you probably did 4.2 million down on this property. That's your equity. You probably borrowed it from, you syndicated it, borrowed it from coworkers and friends and family. You was able to buy it. You took out a loan for $7.2 million. That gave you a DSCR of 1.28. All right, we could push that and probably get the DSCR to 1.25 back in those days. If you look here, you'll see yearly payments. You take that NOI minus the yearly payments, that gives you your, $120,000, $121,000 cash flow. Pretty good deal, right? I mean, that's a textbook on how a deal would be structured. Now, let's fast forward this same deal. Let's say now we're 2024. This same guy had a 5-year term on this $7 million loan. 5-year term. He's maybe been able to bump rents a little bit. He's done some rehab, things like that. He's bumped rents a little bit. But let's say this property's in Florida, and now instead of $700 a door, he's paying $1,500 or $2,000 a door for insurance, because of inflation and the hurricanes and all the things that's happened. So even with his increased income, his NOI is still $500,000. This right here, guys, is just a vague example of what we've been running into over and over and over and over. People coming to us, hey, we need to refinance. Our loans coming due. We need to refi. We need help. We need help. We need to refi. Watch what happens to this loan when we change. So when he goes to his interest rate changes from 3.5 in 2024, his debt's due, and we go to a 6.5% interest rate. His yearly payments are now 47, almost 50,000 more than what his NOI is. And he's got, so he's got a negative DSCR. A couple things could happen. And a lot of different things happen in this situation. If you have mom and pop owners that this kind of stuff is happening to, I mean, most of us, we have, we see, 50,000 less in cash flow, and we're having to pull 50,000 out of our pocket to make the payments every year. We might decide, we don't need to pay that landscaper. We can go cut the grass ourselves, right? And we're probably not going to do as good of a job. Or, we can go clean the hallways ourselves, or we can go lease apartments ourselves and we take over management. And, we might be able to save some money that way. But are you going to do that just to be able to break even for very long? That's the situation some sellers are in, or this same buyer, the same owner of this property. This guy might, own 10 or 15 of these, or this guy or girl might own 10 or 15 of these. So now what are this person's options? So one option that they come to us for, because they go to a broker and they say, hey, Mr. Broker, I need to sell this property. I need your help. I need out. And what's the broker going to say? Yeah, we can sell it. We'll put it on the market. We're going to sell it. What are you thinking you want to sell it for? And this guy is going to say, well, I bought it at a 4.5 cap. I'd like to sell it for a 4.5 or a 5 cap. And that guy's going to say, well, when your interest rate's going to be 6.5, good luck getting, a 5 cap out of a property that, they're going to be upside down on their, interest rate to cap rate. A lot of people don't like to do that. Their returns ain't going to be there. So, this same property, I said 500,000 NOI today, 500,000 divided by 0.07, it's $7.1 million valuation on this property now. So 7.1 million is less than his original loan amount. So I think this guy's in big trouble now. So what I'm going to do here is I'm going to mess with the down payment, which will adjust the loan amount to give us a DSCR that will that'll pacify the bank, because the bank is going to check this on a regular basis. They're going to come, they're going to want to see, especially when the debt goes due, they're going to be wanting to do, inspections of the books and all that to make sure. And if you have a negative DSCR or you're not meeting the DSCR requirement of the bank, a lot of times the bank will take the property back from you. But this same property, if we go to like a 50% loan to value, see, a $5 million, we can't get a $5 million loan on this property at 6.5. So that's $5.5 million loan. Let's see, if we go to 55%, 45% leverage, that gets us to a $5 million loan gets us to a 1.3 DSCR. So if they were to come in and try to refinance us to a new term on the loan, they're going to have to come in and bring about, $2.3 million to be able to refinance. And I'm telling you, most of the sellers have borrowed money from friends and family and coworkers and fundraise and all that stuff to close these deals. They don't have access to another 2.5 million to be able to do this. So when you hear two people talk about pain in the market, this right here is the pain in the market. I have talked to so many people that are in the same situation. Different loan amounts, different NOIs, all this stuff, but they're in the same situation where if they go to sell this property, if this guy was to sell this property that he bought for $11 million and he sold it for $7 million, those friends and those family members, his doctors, lawyers, his son and daughter's classmates' parents, maybe they invested with you. These people's money's gone. So every dime of it's gone. And I've been seeing it more and more, where, oh, well, so-and-so just lost 500,000 in a syndication deal, or they just lost 50,000, or, oh, he just lost his mom's 401k. She decided to do a self-directed 401k into his property and it lost it all. And these things are happening. This is the pain in the market that that people are talking about. And there we go. So that's the pain in the market that people are talking about, and why one of the most important things you can find out when you talk to a broker about a property, when you're talking to somebody about a property and you're trying to feel out the seller, is why are they selling? That is the most important question to ask. If they're not in pain, is that if that guy's got a 10-year, he bought that property for 11 million, 5 years ago and he's got a 10-year term on that loan, he's not a seller. Because if he sold today, that loan, that property is going to sell for 4 million less than what he bought it for, and he's going to lose all that money or lose all the people's money that he's managing it for. He's not a seller unless he gets his money. And he was hoping, you know, when he bought it for 11 million, he would turn around and sell for 16 or 17 million. I know. And it's just not the market that we're in. You know, a guy like Grant Cardone, you know, he's saying, oh, well, we could go back to 0% interest rates. That happens. I mean, this, you know, $11 million property might be 20 million or more. You know, I don't know if that's going to happen or not. You know, if we go to double digit rates, you know, where some people are saying that's what we could see. You know, that same property could be worth, you know, $2 or $3 million. You know, so it's right now, if you're buying property, you know, if you believe that the interest is going to come down, you know, you're on that bandwagon, you think it's going to happen. I hope it happens, you know, for the sake of our business and for our financial future. You know, I mean, I hope that happens. You know, take out those 5-year terms. You know, if you think, oh well, rates could go way up, you know, hey, take out a 10-year term or extend it even longer. You can do a 15-year on a lot of these, but you're going to pay a little higher interest right now, you know, but you would have more, you know, stability. If it cash flows right now and you've got a 15-year term, it'll cash flow for 15 years. So how does an owner, you know, overcome this? You know, right now they're not going to be able to overcome it. I mean, the Federal Reserve, they've been having these meetings and they're talking about, oh, well, we're going to lower rates. We're going to lower rates. So this is going to happen. That's going to happen. It's not happened in, you know, 9 or 12 months, whatever it is. They've been saying they're going to lower rates. They've not lowered once yet. You know, our rates shot up by, I think, what, 5 points in 6 months. And what they're talking about lowering them now is they're talking, oh, we're going to lower them. But when they're talking about lowering them, they're like, oh, we're going to lower them a quarter point, 25 basis points. You know, a quarter point isn't going to help people that are in that kind of trouble. You know, they're still going to lose money on that deal if they sell that deal. And what's going to happen is as more of these loans come due over the next 3 years, and rates, if the rates stay high, stay where they're at, you know, the banks are going to force sales. They're going to say, I don't care about your equity. We're not working with you. We've got too many loans like this on our books, and they're going to force sales. And that's going to allow people like us to come in and buy them, you know. But I would say, work as hard as you can to build relationships with people that have money so you can buy them, or work on your business, whatever it is that you do to make more money, to be able to put more money of your own money in them and buy them, you know, because there's going to be some good deals in the marketplace because of what we just talked about. So the next few slides, we're not going through those, but I can go ahead and open up for question and answer. If we have any questions, feel free to just blurt them out. I'll go ahead. We got 9 minutes. And I think I just heard thunder outside. We got storms coming in. So if we cut out again and we don't come back on, our power might be out. So okay, I see Jeffrey. I see your hand.
Yeah. Hey, Jerry. I put it in the chat though. How do you find REO multifamily apartments?
There is places where you can go to find out when people's debt and things like that is due. So I think, you know, it's usually the paid programs on like Crexy. Grant Cardone has one called 10X Deal Finder now.
I got Crexy.
You know, and you can actually type in, you know, your area that you're searching. And then on his, you can actually type in, I want to know about any properties that have debt coming, you know, due in 2024 or 2025 or whatever it is, you know, and you can do searches like that and then just get on the phone and, you know, try to find the owners and talk to them.
Okay.
Yeah, so there's not really any REOs, once the banks take them back, the banks usually already have people that are in good standing on other deals. And they take those deals and they say, hey, bud, you got 5 other loans with us. You want another one? And they'll give them that property. And they get good buys on them because they're there and already in place. So
It's not what you know, is who you know.
yeah, yep, for sure. Yeah. So, but yeah, some of those can be real expensive. CoStar, different ones. I mean, they're pretty big investments to make, but you can get the information on those things like that. And so while you guys are thinking of questions, I'll go ahead and keep rolling through our slides here so we can, if we don't keep rolling, we'll not finish. So things that we need, if you want help with a quote, you have anything going on that you're wanting us to look at, feel free. I'll have my phone number here at the end of the call. I'll put it up and my email and things. But if you're calling, you have a multifamily deal you want us to give you a quote on, T12 rent roll and OM is helpful. I mean, I know the OM is a sales pitch and a lot of what's on it's exaggerated. But a lot of times the T12s and rent rolls don't have addresses. And so the OM will have an address. It'll tell me, give me pictures of the property, all those types of things. So that's real helpful. A summary of what you plan to do with the property. So what are you thinking? Like, did you underwrite the deal? Do you have like a purchase price in mind? What you're going to send an LOI in for, whatever it is. Things that we will need as we move on is SREO, schedule of real estate owned, and personal financial statement. And I'll say that. I see your hand, Jeffrey. As soon as I'm finished here, I'll catch you. The SREO is schedule of real estate owned, personal financial statement is your PFS. Those things, to be able to qualify for a multifamily loan or a commercial real estate loan, you need to have a net worth equal to or greater than the loan amount to be able to qualify. Equal to or greater than. Now, if you have several people, maybe a few of you have, a pretty good net worth and you don't qualify individually, but you could have 3 or 4 or 5 people, put their stuff together and qualify together. Or, a lot of people find a sponsor that has bought a lot of deals and they say, hey, I like that deal. I'll sign on the debt, give me 5% ownership. There's a lot of people that do that stuff for new buyers. So go ahead, Jeffrey.
Yeah, Jerry, I have a question. So do you all do second loans, second mortgages?
We can here in our local market. We have a good resource for that in our local market.
Okay.
We now on multifamily, yes. If you're looking at like single family rentals and things like that, nationally,
Multifamily.
yeah, on multifamily, depending on the deal size, usually if you have if your property, the purchase price is above 15 million, there's a lot more options for that. So if the purchase price is 15 million, your loan is, 8 or 9 million, and we could probably come in with 2 or 3 million, and then you could come in with the rest. There's not a lot of options for that, like if you're looking below those loan amounts. So I have a few guys that do those, but they won't come in for any less than 2, 3, 4 million at a time.
Okay, so let me get a scenario of the deal. Purchase price 8.1 million. The seller has a assumable loan of 5.1 million at a 3.71% interest rate.
Okay.
So he's willing to keep that in place.
How much is the loan for?
The loan is 8.1 million.
And then your purchase price?
No, I'm sorry. The purchase price 8.1 million.
Okay.
The assumable loan is 5.1 million.
Okay, gotcha.
At a 3.71% interest rate.
Yeah, I mean, could possibly find somebody to come in for $1 million or so. You probably wouldn't get somebody come in any more than that.
Right.
Because they want to see skin in the game.
Of course.
Yeah. So, if you have one that that you're working on like that, I'd love to take a look at it with you. First thing you need to do to be able to do that is you need to get the loan docs on the original loan. Do you know what that original loan is? If it's a Freddie or Fannie or what it is?
I know I have it. I'm not for sure. I know it's assumable though. Yeah. So
Yeah.
most likely it's one of them. Yes.
Well, yeah, I mean,
I can find out.
it could be a local bank or anything, and depending on who the lender is, sometimes they will allow somebody to come in as a second, sometimes they won't, so.
Okay.
So we would have to look at that before we could really give you any definites.
Sure.
But yeah, I mean, generally we can, but 5-6 years ago, those were real easy to get done. Bringing in extra cash, those people would make 10-12% on their money, whatever it was, and get out of it real quick. A lot of those people that put money into deals, 3, 4, 5 years ago, their money's still in that deal and they can't recycle it for the same reason we just talked about with those deals. These deals aren't spitting out the equity growth like they were 5 years ago. And so a lot of the bridge lenders, I mean, we had 25 bridge lenders that we could do business with before the rates kicked up, and now we've probably got 15 of them just totally out of the market and not doing business anymore because their capital is all tied into deals and it's just sitting there stagnant and can't move. So yeah, that's kind of the problem with the market right now. Is a lot of the money's just sitting and can't recycle. So, but yeah, those types of deals we can do. What we can't do is a third. I have people call sometimes about, hey, we got a second, we got this, we got that, and we need to raise another 500,000. Could you loan us the other 500,000? And now you got to go raise that. Roll your sleeves up and go raise it. There really isn't options out there as far as banking options that would do that. So, if you're looking at smaller deals, you're looking for a DSCR loan. Things we need: address, purchase price, if it's a purchase, if it's a refi, purchase price, date purchase, current value, monthly rent, taxes and insurance cost, and borrower's credit score. What can you do today to be prepared tomorrow? I think most people on this call, if you're not there already, you want to get there to where you're the person signing on the debt. So things you need to do to get ready for that. Make sure your credit's in order, your personal credit. You hear the guru saying, oh, you don't need credit, you don't need this, you don't need that. If you ever want to be the person signing on the debt, you need to get your personal credit in order. Henry, I see you, man. How's it going? Work on your own personal financial statement, your SREO. Work on raising capital or just making more money. Start now talking to people about, hey, I'm working on and, buying some real estate deals and talking to them about that. One way to make more money is we have a referral program. If you refer business to us, we will pay you for that referral if we close a deal with them. So we'll be doing a call eventually on the referral program. We've been saying that for months now, but we will get around to doing that. This week's verse, Deuteronomy 8, 17 and 18. You may say to yourself, my power and the strength of my hands produce this wealth for me. But remember the Lord your God, for it is he who gives you the ability to produce wealth, and so confirms his covenant. So I'm thankful to God for the abilities he's given me. And hopefully you can say the same. Our next topic is how to prepare for a commercial loan. That'll be on August 7th. Here is the QR code for the WhatsApp chat that Shelly was talking about at the beginning. So there's some big people in this WhatsApp group. Michael Blank, if you guys are familiar with Michael Blank, he's in the WhatsApp group, in the Freedom Chasers WhatsApp group. So And there's others, different guys that have their own mentorships that they charge for and things. And so some pretty cool stuff going on in that WhatsApp chat. So if everybody's done there, here's our contact info. That's my cell phone number and then mine and Shelly's emails. And then that QR code is to my Hi Hello card.
I wasn't able to get the QR code for the chat.
For the WhatsApp?
Yeah.
Okay. There it is. All right. Did you get it, Larry?
Yes, I did. I just joined.
Okay, cool.
Thank you.
Yeah, no problem. So there's our contact info. Feel free to reach out anytime. I stay pretty busy on the phone a lot of the day. If you send me a text before you call or whatever, that's always helpful. Or just send me a text and say, hey, call me when you can. It's so and so. I'm looking at an apartment deal, and I'll call you back just as soon as I'm able. But become a part of the community. My wife and I, we've been in quite a few different mentorships. We even had one mentorship program. We paid $40,000 for a year to be in. And I will tell you that the people that are teaching here, we work full-time in real estate. Ed and Kevin, full-time real estate brokers. They're full-time real estate guys. They just bought 120 unit in Destin, Florida. Bibby and Iffy have bought a deal in Pennsylvania recently, 100-something units. I think they're working on their third deal now in Texas or somewhere in the Carolina. I'm not sure. Trevor, he's got a pretty good portfolio going. So these are all real estate people. Some of us full-time real estate. Some of them still freedom chasing. They're working their full-time jobs, professionals, and are working on buying apartments at the same time. So the value in things, I'll tell you, my wife and I, we paid $40,000 for me and her and our two boys to be in a mentorship program. Went to the first weekend, and when we got to that first weekend, within 10 minutes, 15 minutes, I realized the guy teaching the class had been taught how to teach a class and had never bought a real estate deal in his life. And none of the people there there was some people in the crowd that had bought real estate deals. We met some of them, but the guy teaching the class had never, we asked for our money back, because we're supposed to be buying from these people and are buying, learning from these people that do it. Our main purpose in joining the group was so we could network with real estate investors. But yeah, so I mean, this community here is the only one I know of that offers this kind of education for no cost. So take advantage of it. And thanks everybody for being here.
Yeah, I just shared the Facebook link again in the chat. If you haven't grabbed that, go ahead and grab it. And if you want to look back at this recording, if you missed something, or you can go back, and it should be up tomorrow on that Facebook page or on the YouTube page. I feel like I was going to say something and I forgot. Anyways, thank you guys for joining. Hopefully we added some value to your real estate journey. You guys have a great night. I will leave you guys with some music. Bye.
Good to see you guys.
Hey, you too, Aldo. Good to see you, man.
Hey, Aldo, you can say a few words if you want. Go ahead before I play some music.
No, it's good. I was just saying hello.
Hey, was you all able to close on that deal in Tennessee?
We did, yeah.
Yeah,
We did. Yeah. So we're very excited about it. Been doing a whole bunch of initial asset management. So this is the fun part, not the raising money.
Yeah.
I don't have that particular set of skills.
Yeah. Well, cool. Congrats, man.
Thank you. Appreciate you guys. How's deal flow for you guys?
We're looking at a lot of deals. There's not a lot of things that are penciling out right now. You know, I mean, we're looking at more deals. I mean, we're looking at a ton of deals, but it's just,
Mhm.
you know, getting ones that pencil out. Most of the deals that we're seeing that are bought are on assumable debt. You know, there's not a lot that's being bought otherwise. So,
No, there's not a whole lot out there.
I mean, once we get past the election, who knows what'll happen then? I mean,
Yeah,
we have a guy there that's a real estate guy. You know, he might make a difference in office. You never know.
we'll see.
Yeah, I do know that Jerome Powell, this is kind of just free information. Jerome Powell was on Bloomberg a couple months ago and was talking to them, interviewing with them about the interest rates. And they asked him the question, you know, what is the Biden administration saying about the high interest rate environment that we're in now? And, you know, what do they think? What's their advice to you and what they would like to see you doing? And he said, "Oh, I've not had a conversation with them." And so, I mean, it was, you know, 2 years into rates going up 5 points in 6 months.
Sure.
And, you know, our leadership of the country hadn't even talked to the guy that was raising the rates, you know, so
Right.
it's kind of crazy, but
Yeah, very interesting. Well, good, man. Yeah, hopefully we'll see something out there, and there are deals out there.
yeah. Yeah.
But anyway, well, you guys take care. It's good to see you guys, and good to see everybody on here. And
Yeah.
best of luck.
Yeah. Thanks, man. I see
Hi,
you.
Anna.
I see you, Anna.
I had a quick question, and I hope it's quick.
Yeah.
Yes, I realize some people are taking on assumable loans, so they're penciling out that way. But let's say you get in at a 4.5 cap now. Like, is there any guideline on what you would use as an assumption to exit the property? Because I'm pretty sure your buyer down the road would not have a 4% or 5%. Well, I can't say I'm pretty sure, but
yeah, you never know. What I would say is, you know, real estate, if you look at the last 100 years of real estate, every decade real estate's gone up dramatically. But if you look at it decade to decade, it's gone up just like this. Now, if you look at it over a 5-year period, you're going to have times where it goes down. But over the long term, real estate continues going. So if you buy that assumable debt, if you're comfortable with the cash flow and you have a long time before that debt runs out, you know, you might be okay. It's just a matter of what you think, what you think when you're looking at long term. You know, what's it going to be when you go to exit? You know, is it 10 years that you have this debt for? Is it 7 or 8? Whatever it, you know.
so the length of the loan, because it's cyclical. Yeah, I've been underwriting a few deals, and I'm like, this exit cap rate is not going to, even if I assume the loan at a low rate, when the buyer goes to get financing, chances are their rate is much higher than what I got it for.
And I would say, you know, just because somebody has a low rate isn't a reason to give them a really low price. I mean, yeah, looking into that low rate can be really good, but you know, if you don't see an exit, don't get in there. You know, you always have to see an exit. You know, even if that exit is just, you know, I refinance it at the end of the term and I'm still good on my cash flow and things, that's fine. It don't have to be a sale, you know, but you know, those can be tough to underwrite and figure, but if other things in the market, I mean, if other things in the market are selling at a 6 and 7 and 8 cap, You know, there's no way they're ever going to get anybody to pay a 4.5. So no matter what their assumable debt is. So yeah, I mean, you can account for some of that, you know, assumable debt, you know, that'll be a helpful thing for you, but I wouldn't, yeah, I might give them a 6 cap or a 6.5 instead of a 7. I'm not going to give them a 4.5, you know. So
Gotcha.
I don't think anybody else would either. You know, these properties, a lot of these properties are on the market. They're going to stay on the market because, you know, there has to be the pain there to make them sell. In a deal like that, where they have assumable debt that's pushed out for so long, there's no pain. They don't have to sell. If they get a 4.5 cap, great for them. But, you know, you have to find out, why are they selling? You know, if they have long-term debt, you know, fixed for long time, there's no reason for them to sell. And they're, you know, the pain is what's going to cause the good deals.
Unless their interest only period is running out pretty close to the time they're selling, and so, you know, it stops penciling at that time, and they're selling you a 10-year deal at year 4 or something like that.
Yeah. I mean, that there could be some cases like that where they're wanting to sell because of that, but then at the same time, it's, you know, that doesn't mean you have to give them a 4.5 cap. So
Got it. Thank you, Jerry.
yeah, no problem.
All right, good night. Thank you, guys. I will leave you guys with some music. Bye.
When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. Getting money, never losing no. But I'm broke, but now I'm living at it. Digits, comma zeros, and some decimals. Wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico. I invested though when I let it grow. Benjamins, I got a pocket full. Rich the income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be, like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I